Gentlemen, thank you very much for joining us on behalf of Micah Finance Solutions. Thank you, Eric, and for everyone taking out and affording us their time this evening. Property is obviously a subject which you can't walk 5 feet without anybody talking about it. So we would really like to be able to share a couple of things with you tonight as to what is happening in the property market from some of the brightest economists we have in the country, who I'm going to share some information with you shortly. My name is Warren Jacobs. I'm a senior investment property consultant at Meridian. Adam Duffy is Glenn's partner, and we're here tonight to really explain to you the uniqueness of our methodology and how we get to our analysis, and really how we can assist getting a client through this process, which is a very tricky and difficult process. Firstly, let me just quickly make a disclaimer. This is just general information. Obviously, one would need to know what your own specific needs are. So please don't go out, run out and buy property right now. This is just general information.
Yeah, everyone will be offered a chance to sit down and individually go through your circumstances where we can present something a little bit more suitable to what you're looking to do. But until then, just general information.
Yeah. So who is Meridian? Well, we were founded in 2011. We really are a research house, looking at a real estate agent that has a license to sell, as well as doing a significant amount of research. I'm going to show you a little bit about who our investor panel is, who really enable us to have our investors make very wise decisions in the space. As I mentioned to you a little earlier, this is a very tricky space. In fact, the statistics are 75% of investors only ever get to buy one property, which is a heck of a failure rate unless your auntie is leaving you a 5-bedroom house in Vaucluse. So, and our team really love to be able to provide our clients with support throughout the entire process, from getting the very best analysis to getting the very best tenant and everything in between.
Yeah, essentially Meridian's service is to assist our clients to at all times ensure they are buying in the right market at the right time, investing in the right type of property and paying the lowest possible price. So our service is about assisting the investor through every single stage of that process, and ongoing review and ongoing assistance as they continue to build their portfolio, if that's the path that they've decided to take.
So I did mention to you a little bit earlier about the sort of analysis that we have, and really what sets Meridian apart in terms of that property analysis. So sitting at the top of our panel, of our Meridian investor panel, we have an independent, unbiased panel of really economic property heavyweights. I'm sure you would have all remembered BIS Shrapnel, who merged with Oxford Economics. Rachel Logie and Sarah Hunter are the chief economists at BIS Oxford Economics. They are the greatest data collection agency on the planet in terms of what effects different economies have on property. Terry Rawnsley, Bethany Finney, they head up SGS Economics and Planning. If Mrs. Berejiklian wanted to know what was required on the northern beaches, because we're now building a new hospital, they would rely on SGS Economics and Planning for their information and their advice. Timothy Fisher is the Associate Professor of Economics at Sydney University. He really gives us a global perspective as to what's happening, and if things are happening in America or China or New Zealand or Europe or Japan or India, how is that going to affect the property markets here in Australia? And it's never more evident than right now, particularly while we've got a little bit of a hold on immigration. His information is absolutely invaluable. And then, like anything in life, one wants to be able to know, well, what is the supply to a certain demand? Don Smith heads up BCI Economics, and what they give us is an idea of every single development application in the system. So one knows precisely what is going to be coming into a certain area, so that if you see 1,600 units coming to this area happens to suit units, but you've only got 400 people a year moving into that area, you know you're going to have an oversupply situation. So it is very important to get all this information from those economists in terms of what's happening in the population and what's happening in terms of property, as well as, well, what are the numbers that are coming in that are going to be able to satisfy that demand.
Yeah, and analysis essentially sits at the core of what we do at Meridian, and we realized, we've been perfecting this process for almost a decade now, very close to a decade, And it's something we look to specialize in, because we know when correct analysis is done and thorough analysis is done, that is when the correct market is selected to maximize our clients' profit from their property investment. So we have a very unique process, and we're the only kind of company out there with a completely independent panel like this, which we meet with 3 times per year to analyze all of the property markets to determine where should we be investing today, where should we be avoiding. And by all of the property markets, I mean all of our capital cities and our second tier markets like Wollongong and Newcastle in New South Wales, Geelong and Bendigo in Victoria, Gold Coast and Sunshine Coast in Queensland, for example. Now, like Warren said, they sit at the top of our research model and our process that we take to identify property markets. What we look at is things at a state level, city level, and then really right down to a suburb level. And it's extremely important to take that next step from city to suburb, because we all know examples of where suburbs located right next to each other can perform completely differently. So it's very important to continue the process right down. Now, what's our panel and what we are looking at every single stage here? These are really these next 7 things that I'll take you through are really what will determine whether a property market performs well or whether it performs poorly. And what we do is put numbers and analysis and information behind these fundamentals to determine where we should be investing and where we shouldn't be. And our panel there, although all of those experts probably have a commonality that they have economics at the core of what they do, they all have individual specialties, which helps to assist with analysing these things here. Now, the first one's the economy. Now, a good property market needs to have a strong economy driving it. And for us, it's really important, and we'll touch on it a little bit more tonight, but a diverse economy supporting a property market is extremely important, and especially in times like this. But the one thing that a healthy, diverse economy will do is it will attract people to want to live in that area. It will attract population growth, and that can be coming from overseas or interstate migration movements. But population growth building in an area is what will generate demand for property, and we need to see that demand growing in a market. Infrastructure is something we spend a lot of time on analysing. It's really one of the ways that we can get a foot up on the average investor, is we can identify where future infrastructure projects are occurring, like new hospitals, new CBDs being created, new schools. These are essentially things that SGS and BCI, they help us to do and identify before it's really publicly known and acted upon info. But new infrastructure being developed in an area is what will generate the future economy, future jobs, which will generate future population. So you can use it to start to forecast what the property market's actually going to do. We also like to invest in areas that are fairly established, right? So things like schooling, public transport, shopping centers are already existing in that market, because what we want to see is a very high home ownership in an area we like to invest in.
And you want a good spread of infrastructure. So it can't just be one program or one project. If you do a pipeline in Karratha, it might look on paper as, this is a X billion-dollar project, but it needs to spread across a lot of different types of infrastructure that do attract the right type of people to enhance that population growth.
Absolutely. Rental yields is a really important factor too. A good property today, we won't go through the ins and outs of the cash flow of a property investment, but a good property today shouldn't be costing the investor anything to hold it. Every cash flow that I've done for the last 3 to 4 months has been extremely cash flow positive on every property. So there's a few things that need to be in place to achieve that, but a strong rental yield is one of those things. Now, those first 4 things we've gone through there quite quickly, they all relate to demand for property. And you need to invest in a market where there is a high demand being created. But there's something that you also need in place to generate price growth, and that's low supply. This is what I find a lot of our investors neglect, especially when it comes to analysis, because it is quite difficult to get information on the supply for a suburb. But there's really 2 ways you can look at a property market and determine, okay, today, is that market oversupplied with property and one that we should avoid? Or is it undersupplied and it's a market that I should be investing in for growth? And that's in the vacancy rate. The vacancy rate will tell you the percentage of property that is sitting vacant within a suburb. If a suburb has a vacancy rate of 3%, it's an indicator that the market is balanced. And a vacancy rate of 4, 5, 6, 7, 8%, the high vacancy rates means it's oversupplied and one you should stay away from. And I can rattle off plenty of suburbs around Sydney right now that are representing very dangerous vacancy rates, and they're very oversupplied markets. We want to be below 3%, the lower the better. 2% is an indicator that the market is undersupplied.
And really the sustainability of that supply, going back to what Don from BCI Economics is giving us, it's all very well going on. We've got a nice low supply in this particular area, this particular time. This is great.
Yeah.
But if you're analysing what those development applications are coming through, well, then you could all of a sudden find yourself in a rather oversupplied situation.
Exactly. That's the other way to look at supply. You can look at it present, and in Australia, we have a very good ability of looking at forecasting the future, because supply, before it becomes supply, a new property, whether it's a unit, a townhouse or a house, it needs to go through a very rigid development process. And that's what BCI track. That's their specialty in this whole panel. They produce that one piece of information about every single suburb we're analysing to determine, are we investing in a market where not only it's undersupplied right now, which is great, but they're also not building enough property in that market moving forward, so it will remain undersupplied. Because again, there's plenty of markets that we've looked at that will have a very low undersupply right now, and it's fantastic. It'll look good, but you can see a huge pipeline of construction of supply coming into that market, and you should be avoiding it for that reason.
Yeah, absolutely. And particularly also when you see that a regulation will change where height restrictions have gone from 3 levels to 9 levels.
Yep.
You know exactly what's going to happen.
Yep.
I don't know too many developers that don't like to take advantage
Maximize
of free airspace.
Yeah, exactly right. Another one is availability of credit, and Eric's on the front line with this. It's a very changing landscape, isn't it? But availability of credit is something that impacts the demand for property as well. It's something that needs to be monitored. But the last fundamentals are a very important one. Now, not a lot of people know this, but I suppose most of us here would know it if we're based in Sydney. But from the end of 2017 through to 2019, seems like a little while ago now, but the Sydney property market actually corrected 18%. It went backwards a substantial amount. But if you look at Sydney in 2017, it had a very strong economy, great population growth, infrastructure spending is at record highs. Rental yields are quite low. Supply levels are starting to build in certain areas, and availability of credit was a bit iffy at that time. But the main thing that drove such a sharp correction in Sydney property values was affordability, without a doubt. It reached a very high level, which is a very unaffordable level, which is something that you want to avoid. There's a way that you can calculate how affordable a property market is, and we'll take you through that later tonight. But we should always be investing in a market where there is a high amount of affordability, which means that property values can increase from where they currently sit today.
So they was normally measured in a way where, depending on how much of our disposable income we're spending on our mortgages and or rent. So when you're around about 25%, you've got room for growth. You're talking about Sydney and Melbourne. They were close to 40%.
Close to 40%, which led to a correction. Above 40% is an indicator that the market is unaffordable. And
going nowhere.
In 2017, Sydney hit 43%. So it's very clear to see that the market was due to correct, and it did very sharply. It's only then, after we've done that macro analysis, and I can't stress enough that if we're looking to invest in a property market where we want to reduce our risk and maximize our chance of performance from that property market, it's extremely important to make sure that property market has ticks against every single one of those 7 fundamentals there. Even one of those being questionable or being a bad fundamental, the market should be avoided. It shouldn't be invested in. The next step shouldn't be taken to identify the right property for that suburb. Doing the macro level research and analysis right will always reduce your risk and maximize your chance for gain from that property investment. Once you've found a suburb though that meets all that criteria, then it's extremely important to continue the process and identify the right type of property for that suburb. So based on the demographic who is present there, make sure you're matching the type of property you're investing in with the demographic that is in demanding the property to the maximum today and moving forward. For example, a market that is dominated with families with children, and that's the growing trend, don't invest in a one-bedroom apartment in that type of market, of course. Whereas a market where it's a very young professional dominance trend, which is growing, household sizes are shrinking, I wouldn't recommend a 4 or 5 bedroom home on a huge block. That's not going to be so suitable for the demographic that's trending in that area. And value for money, this comes down to negotiating on that particular property and making sure that price is as low as possible. And Meridian, we utilize many different types of strategies to reduce that price as low as possible.
Yeah, and you're working with the right team. You're working with somebody who hasn't gone broke, hasn't caught anybody any money, hasn't gone too far and overcapitalized, or gone too shallow and undercapitalized.
Yep.
And the funny thing about that slide, in the first, when we started this conversation, I was talking about why 75% of us fail, or we only get to buy one property. And really, when you're looking at that slide, most investors will start with the property.
Yeah.
Whereas really, it is the property that comes last.
Yeah.
So the homework needs to be done first, and then we find the appropriate property, whereas most investors will run at the property.
Exactly right.
So tonight, what we want to really be able to do is to get away from what some of the mainstream media hype has all been about and focus on what is actually happening on the ground. So we will be able to show you exactly what has happened to the property performance across our major cities over the past 3 months. We'll also be able to look at the forecast as what BIS Oxford Economics are forecasting over the next 3 years. How do we identify a very strong property market, which we've kind of given you a couple of hints on that already.
Yep.
And really, is 2020 a good opportunity or not? We're going to be able to discuss whether there is a good opportunity in this difficult climate or not.
Exactly right. I think it's extremely important at all times to focus on the facts, and that's something where we've established that model that we've just gone through there in detail, and it really takes the emotion out of property investing. You can really analyze a market and determine if it is a good one or a bad one purely based on numbers, not based on what Channel 9 News is telling you at 7 p.m. at night or whatever's on Channel 9 these days at 7. I guarantee it's emotionally charged, whatever it is. Right now, it's important just to focus on the facts, not on emotions or opinions or any of this emotionally charged kind of rubbish I've seen coming out in the news of late. So what we want to do to determine what can we expect from the property market moving through the COVID pandemic, for example, moving forward, how's the property market performed in the past in similar types of financial events? This graph here, what it looks at is Australian property growth rate, and that's what the orange line is here. Every year that orange line is above zero, it means that the property market is growing. And this has a look at some financial catastrophes over the past 30 years and how the property market has been very resilient through the global financial crisis, through the Asian financial crisis, and even our last recession almost 30 years ago today. Property property as an asset class has proven to be a very resilient asset class.
Yeah, and you know, one of the things that I hear a lot now when we talk about the pandemic is you'll hear people say, well, we never had one of these before, which is exactly, I mean, you can see from my face, I've been around a while. I wasn't here for the Spanish flu, but certainly for all the other catastrophes you see on that screen, and every one of them was, we've never had one of these before. Yeah. So, the rebound should be good.
And, you know, the volatility of the share market hasn't always flown into property values. It's for a very long time, share prices and shares have been a very volatile asset class. This year looks at that volatility of the share market in the dark blue line compared to the performance of property values, which tends to be a little bit more boring, a little bit more stable. But, you know, that's essentially what we're attracted to as investors. I think in the month of March, the share market lost the ASX 200 went backwards 30% in 1 month. And that led a lot of pundits to expect property values to kind of follow the same path. But again, volatility of shares has always been around compared to low volatility in property. I think that's for a couple of reasons.
Yeah, no, absolutely. I mean, firstly, you've got property as an illiquid asset. It takes a long time to sell. It's not something that you can just buy and sell on a telephone call like you can when you're phoning a broker. You've got the property market. I beg your pardon. The stock market is 100% investor owned. The property market, or one of the reasons we've got one of the most resilient property markets in the world, is that we have some of the highest owner occupiers, and 70% of us are owner occupiers, whereas the stock exchange is 100% investors.
Yeah, exactly. They're very different ownerships, and I mentioned it, but we want to identify suburbs that have this balance. So we want to target suburbs where at least 70% of the property in that suburb is owned by homeowners. It tends to generate a very stable performance from that market, and really well in upswings, because home buyers, we all know it, we're a little bit more emotionally charged when we're buying a home compared to an investment, and that can lead to a good performance.
And very reluctant to sell. I mean, we will hold on to our homes.
Yeah, in times of
distress. Scratching down the carpets. Yeah. So exactly. How have we gone over the past 3 months, Adam?
Yeah. So obviously there's been a whole lot of media articles predicting dire performance of the property market. So how's things actually performed? Well, what we saw was a substantial reduction in sentiment. There was a lot of unknown when COVID initially kind of kicked off. People didn't know how the markets would react, how the economy would react, etc.
Fear took over.
Yeah, there was a substantial reduction in confidence, which this is what ANZ here track, and you can see that the confidence levels got below what was there in the global financial crisis. However, there's been a substantial reduction in confidence. It's risen 42% from March. So while there was a big reduction in confidence, it's kind of quickly came back into the market over time. With that reduction in confidence, what the market did see was a substantial decline in transaction volumes. So a lot less sellers were taking their property to the market.
Yep.
At the same time, there are a lot less people looking to buy property. So you had a situation where sellers were dropping, supply was dropping, and demand was dropping. Both things were dropping. Now, when supply and demand are dropping, that typically won't lead to substantially correcting property values.
And values didn't plummet. Certainly not in sensible areas.
Yeah.
Didn't plummet at all.
Yeah, that's right. Where there has been a bit of a dip in performance has been on the rental. That's where there's been a bit more of an impact to the market, but again, only in certain areas.
Yeah, no, absolutely. And I think going back to that slide where you were talking about having all those fundamentals in place, when you're looking at certain areas, and I recently did a project with my son, who offered a ridiculous rent for something in Newtown. Now, Newtown in Sydney, for those of you, I think we're talking to people who are all in Sydney, Newtown in Sydney would be one of the most desirable areas in Australia to live in. When the rents were plummeting in Newtown, and that they really have, I started thinking, oh my gosh, you've got this desirable area. Why is that so? When you have a look at what the renters in Newtown do, 65% of them worked in hospitality. So when Adam was talking about having a cross-section of a very diverse economy, that is specifically, and now more so than ever, one can see that you've got certain areas in the city, in the inner west of Sydney, that are so reliant on hospitality, student accommodation, those sorts of types of rental, and very heavily weighted to investor stock. So you don't have that 70-30 equation we were talking about, where you don't have 70% owner occupiers, you have 20% owner occupiers. And during a pandemic like this, the renters have disappeared. So has areas like that been affected in terms of vacancy? Absolutely. Have they been affected in terms of your rental yield? Absolutely.
Yeah, rental yield saw the biggest quarterly reduction ever in record in Sydney, led by Sydney and Hobart units, recording steep declines. So those markets, like Warren said, where the biggest corrections and falls were in markets that were reliant on those sources, like hospitality, student accommodation, reliant on overseas migration like tourism. Those markets took a big dip when it came to rental demand.
No, that's absolutely, and as the slide alludes to, you can see the industries that were so heavily impacted by the corona, or still are heavily impacted by corona, particularly our dear friends down in Victoria, who are doing it very tough, and thankfully starting to come out of it, which is great. Some which are partially affected, and you can see the main section, which is that green section. are the sectors of the economy which haven't been impacted at all. In fact, a lot of them are flourishing.
Yeah.
So if you're looking at a suburb whereby you've got that great cross-section of employment and not heavily reliant on the industries which you see in that red factor, you will find that there have been very few vacancies and very little effect on yields.
Yeah, in fact, domain.com release data in regards to investor demand inquiry, and this month we're at a higher level of demand and inquiry than we were the same month last year, just to give you an indicator that the demand is still there in the market. And it's because while some people have been directly impacted through this, and that it's going through a horrible time, the vast majority of individuals haven't had their income impacted at all.
Yeah, so I did an exercise very recently, again, as a project where I compared suburbs that were right next door to each other. So in Sydney, I did Darlinghurst and the CBD. In Melbourne, I did South Melbourne and Docklands. And in Brisbane, I did Tenerife and Fortitude Valley. Fortitude Valley's got the highest population growth in the country. Can't make money there. So when you look at these areas right next door to each other, some of them are talking about yields plummeting about 20-21%. Right next door, separated by Hyde Park, no issue at all. So to be specific about understanding what those macro and micro fundamentals de-risks the situation exponentially.
Yeah, absolutely. Couldn't agree more. So how have values actually performed amongst talks of 32% reductions? Well, the last 3 months, June, nationally at the bottom there, you can see there's quite a spread of performance across the markets, but nationally there was a correction of 0.7%. In July, again, a spread right across the board. Melbourne starting to be a little bit hit here through shutdowns, but 0.6% correction. And then most recently in August, again, Melbourne being hit hardest of all cities, but overall a correction of only 0.4%. So over the past 6 months, over the past 3, the property market has remained resilient amongst all of those other variables that have been changing.
And every month is starting to show smaller losses.
Exactly. Looking at this correction stabilizing. There's markets that have grown over the past 3 months. So cities. So again, that's nationally. It's important to look at it at a city perspective and then suburb within the city. So there was a lot of talk only recently of there being a cliff that we're about to fall off financially in September. But we all know now that the banks have extended the holidays that they were giving to those that needed it. And the government stimulus and intervention has continued. I think it's important to know that property values, there's too many vested interest in property values, which includes our government, includes our banking system. I think, as they say here, they weren't going to have put time, money, publicity into building a bridge to get across to the other side of this pandemic, just to allow us to fall off that bridge once we get over the other side. Yeah,
and besides the extension of your JobKeeper, job seeker, and some are going to get more, some are going to get less. But the incentive packages that the government have put in place now for first homeowners, new homeowners, people doing renovations, has had such a positive effect on the construction industry. And all the infrastructure projects have been brought forward. So in terms of construction and the employment of construction, we are seeing far greater figures. In fact, this month you would have seen that unemployment figures have dropped, which is great. And yes, we've got a long way to go, but we are heading in the right direction.
Yeah, exactly right. And it's our banking system too. It's a very robust banking system. It's looked at from all around the world as being one of the best. Got us through the global financial crisis very well. And they're working. The banks are working very closely with APRA again, just to ensure they don't have an interest. Our whole banking system is propped up on residential property loans. So there's no vested interest in seeing a collapse there. Again, APRA is working with banks to help those that need it to avoid the situation where there is substantial stress selling, which would lead to a correction in values. So no cliff to stress about. So we've looked at how the market's performed in the past. We've looked at the market, how it's performed only recently. What we'll look at now is what our panel, what BIS Oxford Economics are predicting for the property markets moving forward. And they do this for all of the capital cities, and we analyse this very closely with them and take it a little step further. But they've said the direction of the housing market, it'll depend on how quickly the economy can resume full-scale production. And as Warren said, there's been a lot of leading indicators there that are extremely positive. The strength of that rebound, it's been enhanced by government intervention, which is at record levels and earlier than lifting or relaxation of some social distancing policies, except for Melbourne.
Yeah, and the stimulus packages have gone through the roof. I mean, the first 10,000 first homeowners went like that. The second 10,000 are about to be taken up as well.
The demand is
so the government's been fantastic in getting the construction industry going.
Exactly. So there's a lot of lines on this graph here, but it's graphed out all of the growth rates expected for the capital cities across the country. And as you can see here, over the next kind of 12-month period, the end of 2020, they're not predicting a whole lot of growth to come from the market. But next year, we're seeing a move to growth prediction, where we're seeing the growth rates, especially of Brisbane, Melbourne, and Sydney, to move into the double-digit zone again. So they're quite bullish on what they're expecting from the property market from a rebound perspective, expecting to see some strong growth rates move to by 2021 and moving forward from there. And although you had the major banks forecasting pretty horrendous collapses early stages, I'm not sure if many of you have seen them start to revise these forecasts. We only normally hear about the negative in the news rather than the positive, but the major banks are now revising those forecasts. Only yesterday or the day before, Westpac have come through and revised their forecasts substantially. They are predicting that dwelling prices are forecast to move into strong gains starting next year and follow. This is a 2-year gain graph here to be led by Brisbane, in which they're forecasting to see 20% growth in a 2-year period from the Brisbane property market. This is among better than expected economic performance coming out of the pandemic, and record low interest rates, which have led to very high improvements in affordability, which is expected to drive property values moving forward from this point. So interesting to see those revisions coming through.
Yeah, and again, when one gets suburb specific,
yes,
you will see certain suburbs will outperform those numbers. Certain suburbs will underperform those. But that's why knowing your homework and working with people who understand these analysis is so important.
It's a great point, because there aren't, there are markets that won't escape this. There are markets that will have a very poor performance moving forward from here, but there'll be markets that are reliant on those sectors of employment, which are reliant on COVID, which will be impacting us for a good 1 to 2 years, even from here. And that's what we look to utilize SGS for, is to identify which suburbs should we be investing in to reduce our risk and maximize our return. They've recently done a study where they look at all the vulnerable areas. Vulnerable areas is where the population is strongly reliant on income produced from retail, food and hospitality, and tourism related services. So they looked right across the nation, and the darker the color, the proportion in a poor vulnerability. Yeah. And if you look at things from Sydney, there's no real surprise guess based on what we've been talking here, but the kind of most vulnerable area of Sydney is the Sydney city and the inner west of Sydney, where you've got those areas really reliant on tourism, on education, exports,
hospitality, and student accommodation.
Yeah, exactly right. But again, you need to take it further than this to look at suburb-specific data. And up in Queensland, you look. It's no real surprise here. The Gold Coast is classified as quite a vulnerable area because of its reliance on obviously tourism, and especially with the New South Wales-Queensland border closure. It looks like it could potentially be lifted sooner rather than later. But at the moment, it's considered very vulnerable due to that strong reliance on tourism.
Yep, absolutely. So 2020, is this a good time to be buying, or isn't it a good time to be buying? And I think really the bottom line to all of that is really where you're buying.
Yeah.
So, as we've mentioned a few times here today, in terms of being suburb specific, it is very important to be able to understand that all of those macro fundamentals that Adam showed in slide 3 or 4 and the micro fundamentals are in place.
Yeah,
the analysis of where one should be investing right now is absolutely critical. It has never been more critical than it is right now. To understand what a vacancy, whether you're getting the best price available, whether you've got a decent spread of employment across different sectors of the economy, a good population growth, you've got great infrastructure being built in that area, and you've got the affordability factor in place. If you've got those places, if that analysis is there for you to be able to read, see, and verify, it's a good time to be investing.
Yeah, exactly right. It is, and this will generally always be the case. There will be strong opportunities available, and 2020 is certainly the case, because there are certain suburbs right now where vacancy rates are under 1%. They've been decreasing through this COVID timeframe. Affordability has been dramatically improved from the reduction in interest rates, and incomes have been growing in certain areas. So there are some really strong property markets available at the moment in which we can negotiate even stronger due to the climate. So 2020, for those that are looking to invest, is a time to take advantage of, but these things are imperative, is analysis and negotiation.
And just quickly on the negotiation point, you will also find at the moment that you have got some absolute desperados out there. And so when you're seeing something that the price has been slashed and it is just too good to believe, it can't be true, it's because it isn't.
It normally isn't. It normally is too good to be true. When you're seeing large slashing in prices, it's typically due to the market that it's in, right?
And you know, what do desperate developers do? They've got to find
any vendor,
got to find the cost somewhere. So they're giving you a massive discount, which is either added on or taken out of the materials. So one wants to be very careful in terms of who you're working with.
There's no point obtaining a 10% discount in a market that goes backwards 10% over the next kind of 18 months.
Only money you ever make.
That's exactly right. It's important to have both of these things working together. Okay, so I think we've covered a bit of this, but what are the fundamentals for a strong market right now? It'll be a suburb that's supported by a wide variety of employment sources, close to typically multiple CBDs and a low unemployment rate. We really need to put numbers and information behind this.
I can't stress enough the point 2 here, which is your higher owner-occupied suburbs. I mean, it is never more evident, and I'm sorry to keep repeating that, but it is never more evident right now when I look at the investors that I've supported over the last 20 years, how those that are in areas which have got a very high owner occupancy rate are not having the issues that in areas which are heavily weighted towards investor stock. The supply is just not there. The demand is great. We're not seeing great vacancies in those sorts of areas. So having a high owner occupancy rate in your suburb is absolutely imperative.
Without a doubt. We like an established middle ring suburb, so where there's a low availability of land, so not greenfield areas where there's substantial amounts of land, or not in markets where huge high rises can be built. You typically want to target middle ring established markets where you've got an inability to build above certain levels high. We want to see vacancy rates as low as possible, ideally below 2%.
And they may even have restrictions in terms of height, which is another important factor. As we mentioned before, in terms of the supply, there's nothing in life that isn't guided its price in terms of a certain demand over a certain supply. So it is very important to not only know, as we mentioned before, what is happening right now, but to be able to understand what supply is coming versus what population growth is going to be arriving to.
Exactly right. And the last one, as we said, is affordability. There is a way to calculate it. It's the percentage of household income that is spent on the average mortgage repayment in the suburb. So this is data and analysis and information that really needs to be known. That percentage should be, with these low interest rates right now, the percentage should be below 25%. So we can really look at a property market and determine, is it a good one or is it a bad one, based purely on data and analysis. And it's been a very successful model of identifying these markets which performed best for a very long time, and is a model built purely on economics.
Right. So
yes. So that really brings us towards the end of our little webinar here. So we hope you've got some value out of it. We didn't want to keep you too long and bore you with too many graphs, but this really just shows you things at a very high level of the kind of process that we go through to identify a market. And I have to admit, it is probably a little bit more exciting seeing that process applied to a suburb and to an individual property. And that's really where we go from here. If there's anyone kind of watching that's looking to take the next step and maybe explore what their options are now for investment, or they'd like to get any further kind of information on anything that we've discussed today, the first step in that process is just to get in touch with us, either by filling in your name in the chat box here, or getting in touch with Eric and letting him know that you'd like to initiate the process with us. And the first step in that process is just a one-on-one fact find, and that's both ways. So that's for us to really learn about you and what you're looking to achieve, and for you to learn exactly what we do, how we operate, and how we can potentially work together.
Yeah, no, it's very important. We know we're not a good fit for everybody. And so that first meeting is just a fact-finding mission. There is no property discussed. It's what you are trying to achieve, and whether what we do is that we are able to support you or not. If that is the case during that meeting, and you would then say, okay, well, why don't you two go away and come back and give me some suitable recommendations that would fulfill your circumstances and your budgets and your needs and your goals. And in that first meeting, we are also going through an analysis with you to show you exactly what this is going to cost you, including each and every single penny you are going to have to spend.
Yeah.
And then come back to you and say, look, we've got a couple of recommendations we feel that we can put to you.
Yeah, exactly right. It's we'll take you through what's called a due diligence report. It's usually a good 50-page report, which includes not only the details on the cash flow for the property and how that exactly looks in your name, but all of the details and information behind why we've selected that suburb and the particular city that we're recommending for investment as well.
Yep. So it's very important. I mean, buying a property is a very daunting process. I like to actually compare the property managers in this game to a lousy waiter at a good restaurant. Mm-hmm. So it's not just getting the property right, it's getting the right tenant, it's having the right property manager look after you, re-letting it again to a good tenant or to the existing tenant, but finding the right tenant itself. The whole process can be very, very daunting indeed. From getting the information to getting the right tenant, to getting the right insurances. It is not an easy process. Our process is to be able to support Eric and his clients in every single step of the entire process.
And ongoing, I think a lot of people look with property to set and forget. We won't let you do that. We will analyse each property investment our clients invested in and provide a report on that each year to give you an update on the market, an update on the value of the property, an update on whether we should be looking at increasing the rent on your property to that tenant. It's an ongoing process and review.
Annual review.
Exactly right. And our service is complimentary. There is no cost to the investor for our service. So the way that we've set up our business model is that we essentially are using the research to identify a property market that we like. We then begin to engage and negotiate with vendors selling property within that market to secure that property for our clients. Now, a part of that process, we're negotiating with that vendor that if one of our investors purchases their property, they will no longer need the services of a local real estate agent to sell that property. So essentially, we have that fee that would have gone to an agent paid to Meridian in the transaction. And now the benefit of that fee structure to the seller of the property is that they've got our investors from all around Australia that are looking at their property because it's in the right market, it's the right type of property, and they can deliver our client the lowest price. And they pay a normal fee that they would have in that transaction anyway. The benefit of that fee structure to our investor, to all of our clients, is getting access to the service, getting access to the research and due diligence, getting access to the negotiation skill, and there being no fee whatsoever for that at any point in the whole process.
That's it. So there is a little chat box there. If anybody would like to ask any questions that Adam and I are happy to answer for you right now, please type in any questions you've got. We'd love to be able to answer them, whatever they are. Just please feel free to ask whatever you want. And also to remember, if you would like to be able to start the conversation, and that's all it is the conversation, please to get in touch either with Eric, or if you want to put something on your name or inquiry on the chat box, we'd be very happy to join you. Thank you for that nice comment,
Thank you,
Eric. That's very, very kind of you.
We hope everyone got a lot of information out of it. We did take you through quite a little bit in our condensed time that we had together, but like we said, that really is the tip of the iceberg there. There's a lot more detail that we could go through, but any questions at all, thanks a lot, Joe. Feel free to either send them in via email or in the chat box here now.
Thank you, Joe. There's a question there from Michael. If I can invest now, should I?
Personally, I think yes. I think it's a great opportunity at the moment to invest. The interest rates are unbelievably low, as Eric will attest to. Once you start plugging those interest rates into some of the cash flows that we're looking at with clients now, just rental return, the overall cash flow is extremely strongly positive. You're adding that, to the potential for the market to perform as well. You're getting a very strong return from just rent plus prospects of growth at the moment, plus being able to negotiate really well right now. Some of the property has been seeing clients pick up over the past few months being extremely strong.
Yeah, look, and I think that question, Michael, is one has to be obviously cautious of the fact that you have job security.
Yeah.
I think that the big conversation that we're having with people at the moment is the bridging of what's going to happen between now to the time when we get a vaccine for the COVID-19. So, if you can bridge it, if you've got job security and you're in the right place, there are tremendous opportunities right now. And as Adam has alluded to a few times, with interest rates as low as they are, if you've got job security, it's a good time to be investing.
Yeah, we've got to remember always that property investment's long-term. It's not short-term, ever. It shouldn't be anyway. There's too much risk in short-term property investing. It should be taken with a long-term approach. And doing that, you're thinking really what the market will look like in 10 years time or 7 to 10 years time, depending on what your strategy is. If you buy in a well-supported market right now and you pay well within that market, I highly expect that property will perform well over that time.
Question, do you also evaluate investors' current situation? In one word, absolutely. Yes. So in that first meeting, it really is about you. So we want to know that the most important thing for us is your why.
Yeah.
Why do you want to do this? And then we start there. So, well, I want to retire with a passive income. I want to get my kids into the market. I want to pay down my mortgage, whatever it happens to be. That why is what drives Adam and I to do what we do. So yes, it's very important for us to understand what your current situation is and really to get an understanding of what you can save no matter what life is doing to you. That's the budget, not what the bank's going to lend you. It's what you can save every week when life's punching you in the face.
Yeah.
That's very kind. Thank you, Joe.
Sounds good.
Another question. Are vacancies a big problem right now? So just to go back to what we were saying before, there are certain areas where vacancies are an awful problem. I mean, if you look at the CBD of Sydney at the minute, you got a 20.99% vacancy rate.
It's phenomenally high. Highest on record.
If you're investing there, obviously, yes, you would have terrible issues in terms of vacancies, but as Adam was saying too, in the areas that we're looking at, we're below 1% vacancy. You don't have a lot of stock coming in. You've got a high percentage of owner occupiers. There's not a lot of supply for renters. You've got a very good cross section of renters working across the economy. Then you're not going to have vacancies.
Yeah. No, exactly right. It really depends on the market. Certain markets will be hurting from a rental perspective and from a performance and growth perspective as well. But they'll be within markets. It's easy in hindsight to say, but they'll be in markets that shouldn't have been invested in the first place, because you should never invest in a market solely reliant on single sectors of employment, like we've said a few times throughout today. So by following that model there, if you look at markets that have been selected using that model, they're really not experiencing a tough time right now. Like there is very little clients of Meridian, and we're talking over thousands of property investments over the past decade that are experiencing tenancy difficulties at the moment.
Yep. Any more questions? That seems to be it for the moment. There's some very nice compliments up on the screen. Thank you very, very much. We've enjoyed it too.
We look forward to meeting with all of those that are interested in having that first chat and seeing what's for you.
Very enlightening. Thank you very much. There's some honestly terrific feedback on there.
Yeah.
We very much appreciate it. We very much appreciate you affording us your time this evening. And we look forward to speaking to some of you and see how we can assist you along your journey in life.
Absolutely.
So from Adam and I, good night.
Have
a lovely night, and thank you once again.
Thanks, guys.
Take care.